Okay. Hi, everyone. Welcome to Master Key Associate. This afternoon, we shall continue with our series on IFRS, International Financial Reporting Standard. You all know that when we say IFRS, we are also referring to the IAS. These are the accounting standards that guide us as accountants, okay, in the preparation and presentation of financial statements. And this cut across the foundation level for those doing FA, okay, skills level for those doing FR, and the final for those doing SBR. But this class, okay, is for skills and final, exactly, for skills and final. Now, in the last class, we concluded the PPE IAS 16, right? The property, plants, and equipment. Though I am going to send you 2 videos later by God's grace on that PPE, because there is an aspect that we need to touch. PPE is very broad, so, and we cannot sleep on that alone. We have a lot of standards to cover. Welcome to IAS statistics, impairment of assets. Of course, impairment is a term that has been ringing in the minds of many ICANN students. Impairment, impairment, impairment. Now, IAS 36 is the almighty standard, okay, that governs the impairment of assets, okay. So now, before the commencement of any standard, it is important we understand the objective of the standard. Class, the objective of IAS 36 is to ensure that an entity does not carry any asset in its record above the recoverable value. Yes, IAS 36, okay, tries to ensure that no entity carries any asset in its record above the recoverable value. Is that clear? So in order to now achieve that objective, IAS 36 now prescribe, okay, the basis and the procedures for measuring impairment, okay, recognizing impairment. Hello, who is this now? Hey. First off, mute your mic. Hey. My goodness. Okay, as I was saying, right, we don't want to carry any asset, okay, above the recoverable value. Therefore, IAS 36 now prescribe for us, okay, the method of measuring the impairment. Number 1. Number 2, recognition of impairment. Is how do we recognize an impairment in the account? 3, the presentation, okay, of impairment in the financial statement. So that is the objective of the standard. Also, for any standard, there is what we call scope. Scope of IAS 36. You know, we have many standards, right? When you say scope, the scope of a standard talks about those things that that standard applies to. Exactly. Those things, those areas that the standard applies to. That is the scope of the standard. However, we should take note that IAS 36, okay, applies to all tangible and intangible assets. Yes, it applies to the impairment of all tangible and intangible assets, except the following. except this, one, inventory. Okay, inventory is not covered by this standard IAS2. Also, you have construction, contract. Okay, that is what the contract assets, IFRS 15. Also, you have here deferred tax. Deferred tax, IAX 12. We are going to do all this one. Next, you have financial assets, impairment of financial assets by IFRS 9, financial instrument. Also have here investment property, IAX 40. Next, you have the non-current asset, held for sales, IFRS 5. Next now, the last one, asset arising from employee benefit, IAX class. IAS 36 does not apply to all those assets. Why? You can see that before them, they have their own particular standard. So it means that all those assets, okay, are governed by their own respective standard. That is the impairment, okay? The impairment of all these assets are treated in line with their respective standard. Exactly. So that are the things, those are the areas that the IAS 36 does not cover. So having said that, it is important we look at some basic terms, basic definitions. Basic term, because your understanding of IFRS begins from the definition of some terms. Remember, impairment. What is impairment now? Everything is in the material I sent to you. So it's there. Please. I'm just trying to explain. Now, impairment, number one. Impairment, of course, okay, when the carrying value out there, or the carrying amount of an asset or a cash generating unit is greater than the recoverable value. So there is an impairment if the carrying value of the asset or the CGU, the cash generating unit, if it's more than the recoverable value. Is that clear? For instance, in your record, you are having the asset to be 40 million naira. That is the value you have based on your record. But the amount the asset could be sold for now in the market is 38 million. So it means what? You are carrying the asset more than the actual true value. Okay, because that recoverable value is going to be the value of the asset, not the one you are carrying in the record. That is impairment. the excess of the carrying amount of an asset or cash generating unit over its recoverable value. So we are going to look at impairment of two things here. One, the impairment of a single asset. Two, the impairment of group of assets. That is what we call the cash generating unit. Is that clear? Number two, Sam should know, is the carrying value. The carrying value. The carrying value. Yes, the carrying value is also known as the what? As a carrying amount. Out there. This is the net amount, okay? The net amount at which an asset is carried in the statement of financial position. So the carrying value is the net amount at which the asset is carried in the statement of financial position. Is that clear? So the carrying value is determined by saying the cost of the asset, okay? The cost of the asset less what? The accumulated depreciation, okay? And also what? Accumulated impairment. Is that clear? So that is the carrying value. The cost of the asset, okay, minus the total depreciation you have charged up to date and the impairment, if there is any impairment. Next now, recoverable value. See, I can ask you to define this, okay? Yes, it's important. Now, remember that I said impairment occurs when the carrying value of the asset or the cash generating unit is greater than the recoverable value. Now, recoverable value, okay, from that word, recover, that is the value the entity will realize from the asset, either from selling the assets, okay, or from the continued use of the asset. Now, this is an amount. This is an amount that an entity will recover. See now, will recover or realize from immediate sales of an asset, from immediate sale. If I want to sell it now in the market, the amount I will realize, okay, or the amount I will realize from its continued use. So it means that the value of an asset can be realized in two ways. Number one, from immediate sales or its continued use. You continue to use the asset in your organization. Okay, so that is a recoverable value. Fine. Now, IAS 36 says that the recoverable value, hear me, of an asset, okay, is the higher of the fair value less cost to sales and value in use. Just hold that one. We are coming there. Okay. Is the higher of the fair value less cost to sell, okay, and value in use. So that is that. Next, what is value in use? Value in use. I said that the value of an asset, okay, can be what? Can be realized from two ways, right? Number one, from what? Immediate sales. Yes, you sell it off. Or from continued use. Now, value in use now is the present value of the future cash flows expected to be derived from the asset from continued use. Now, this asset, okay, has 6 years life remaining. Exactly. It has 6 years life remaining. Now, what is the amount we are going to realize if we use this asset for the 6 years? So you are going to determine the total amount in cash, okay, you are going to realize as an organization, add it together, okay, and discount it towards present value. That is the value in use, okay? Please, I am coming. That is the value in use. Are we there? Next now is the fair value. Is the fair value. Remember that the fair value, that the recoverable value, okay, of the asset is the higher of the fair value less cost to sell and value in use. So I have just talked about now the value in use. So now, what is fair value? Fair value, of course, fair value is the price, okay, that will be received to sell an asset, okay, to sell an asset, okay, or paid to transfer or to settle a liability in an orderly transactions between the market participants. What are we saying? Fair value now, okay, for the asset is the amount you are going to receive when you sell the asset in a normal transaction, okay, in a normal transaction that is not between related parties. So the amount you are going to realize from the sales of the asset is called the fair value. Exactly, class, the fair value. And for there to be a fair value, there must be an active market. Yes. To be a fair value, there must be an active market. Class. So what is an active market? You can say, it's been long, I can ask this. It's been a long time. Say, an active market, this is a market in which all the following conditions exist. One, the items traded are homogeneous. Yes, when you say homogeneous, okay, they are similar, they are related. Okay, is the market in which the items, okay, in the market are homogeneous, comma, willing buyers and sellers can be found at any time. There is always somebody who is willing to buy and someone willing to sell. Also, the prices are available to the public. It means no one can scam anyone. Yeah, we are all aware of the price. We've all got information about the price of that item. Class, these are the three conditions, hello, that must exist for there to be an active market. Exactly. Now, let us now bring it down. Having understood these basic terms, remember that the objective of this standard, okay, is to ensure that no entity, okay, carries its assets in the record above the recoverable value. Yes, we are trying to ensure that we carry our assets in the record at a realizable or at a true value. Exactly. Then, in order to achieve this now, the standard has prescribed for us, okay, the basis of measurement of impairment. Yes. How are you going to measure the amount of impairment? Two, recognition of impairment. Okay, in the account. 3, the presentation of impairment in the financial statement. So IAS 36 is going to guide us, okay, expressly on these 3 issues. So let's start now. What are the main things that we should consider here? The main thing, please be with me here, okay? We are going now. The main accounting issue, okay, issues in IAS 6. Last, what are the main things we should consider? Okay, what are the main things we need to look at here under this standard? Exactly. Number 1 is how to identify, okay, a potentially impaired asset. Identification of a potentially impaired asset. The first thing, impaired asset. Yes, that is the first thing for you to do as an organization. How? We need to first of all determine, is there any asset that is impaired? Exactly. Now, the standard says that the entity, should assess, okay, at the end of each accounting period. Yes, at the end of each accounting period, whether there are indications, indications of impairment to any asset. You see, you are going to discover some signs, okay, as a company, some signs, okay, that will tell you, okay, the possibility of an impairment. Yes. So at the end of each accounting year, as an organization, okay, you are to assess if there are indications of any possible impairment to any of your assets. Exactly. Now, if you now assess now, okay, you now assess now, and you now discover possible signs, indications, this asset may be impaired. What are you supposed to do? The standard is, if there are possible indications of impairment at the end of the accounting year, make a formal estimate, determine formally, okay, the recoverable amount of that particular asset. Yes. Okay, determine the recoverable amount, okay, of that particular asset, right, that has possible impairment indications. Now, I can ask you, what are the indications of impairment? Yes. Indications. What are those signs, okay? What are those signs? Because you are going to see the signs. What are those signs? Okay? Those things, okay, that will show you that there is a possible impairment. Now, IAS 36 has helped us to classify these indicators into two, right? We have one, internal. Who is that now? Okay, don't worry. Come on, let's check. Wait a minute. We have internal, okay, factors. We have internal factors. Internal factors. We have external factors. Plus, these are the two indications you have, internal and external. Internal and external. Exactly. Okay, now, of course, when you say internal, these are the indications that come from what? From within the organization. Exactly. Number one, physical damage or to the asset. Yes, when your asset is physically damaged, okay, you know that a damaged asset cannot realize the value anymore. Physical damage. Two, adverse changes to the method of use of the asset. The asset is being used beyond the normal pattern it should be used. This is going to affect the value of the asset. Exactly. For instance, an asset that is meant to work for 12 hours in a day is being stressed to work for 20 hours. You see, that machine is adversely being used. Yeah. Next now, three, where the economic performance of the asset is worse than expected. Of course, an asset that is meant to produce, let's say, 40,000 units per month, okay, based on the estimation, and it can hardly produce 20,000. What are you still doing with such asset? Next, where cash flows for maintaining the asset is more than budgeted. Yes, if the asset is taking more from you as a company to repair, to maintain, to service, and what you are spending on the maintenance and repair, the cash flow is far, far more than the budget. Hello, such asset is giving a sign of impairment. Also, where the actual cash flows are less than the estimated cash flows. Yes, we have a projection that come. This asset, okay, yearly will give us this amount of money, but we are getting less than what we expect to get. Next, now, where management intends to reorganize the entity. When you reorganize, okay, the asset might not be fit again for that operation. Exactly. So these are the internal factors. Please take note of that. I can ask you. Next now, external factors that tell us the signs of possible impairment. Number one, a significant decrease in the market value of the asset. On your own record, you are carrying 2.5 million. That is good of you. That is good. Good accountant. But the market value is saying, I bet Jerry, 1.2. Yes. You are carrying 2.5, right? You are correct now. That is by your own accounting policy, okay, and your calculation. But in the market, it's just 1.2. There is an impairment. Okay. Next, a significant changes in technology. Wow. You know, a change in tech now has rendered many equipment useless. Yes, you all know. The moment there is a latest one, I beg, that old one is going away in the market because the world is evolving. So the consumers, okay, the users will have to be updated. They will shift from that one to the new one. Next, when the carrying amount of an entity net asset exceeds its market capitalization. The market capitalization is the value, the market value of the company, okay, of the company, right? But if the net asset of your company, your total net asset is more than the market capitalization, it means your asset has been excessively valued. There is an impairment. Next, now, an increase in interest rate, which adversely affect the recoverable value. Class, interest rate, hello, is a national issue. You know, I told you, okay, it's one of the causes of systematic risk. You cannot control it. If the interest rate jacks up in the country, it will affect virtually everything. Now, what are the two assets that must be tested for impairment every year, whether there is a sign of impairment or not? Please be with me here. IAS 36 says that even if there is no any sign of impairment, as an organization, you must test these two assets for impairment annually. Number one, goodwill acquired in business combination. Remember, in your group account, okay, when you acquire a what subsidiary, you find a goodwill. The goodwill must be tested annually for impairment. Two, an intangible asset with an indefinite useful life. These are the two assets that must be tested for impairment annually. Please take note of this, whether there is a sign of impairment or not. So that is the first aspect. Now, the second thing you need to know is the measurement. Measurement of recoverable. Okay, amount of asset. Yes, you know, I said that impairment occurs when the carrying value is the value in your own record, is more than the recoverable value. Exactly. Now, IAS 36 now says that the recoverable amount, okay, of value, okay, is the what? Is the higher. This is higher of 1. The fair value less cost to sell. 2, the value in use. Class, the higher of these two is what? The recoverable value. Next, when you are asked, hello, what is recoverable value? According to IAS, it is the higher of the fair value, less cost to sell, and value in use. Calm down. Let me tell you, the fair value less cost to sell. Do you know that this fair value less cost to sell is also called the net realizable value? Now, the fair value is the amount I am going to receive from the market when I sell the asset, minus any associated disposal cost. Okay, less what? Any associated disposal cost. So the fair value less cost of sale is the estimated selling price, okay? Or the fair value minus disposal cost. Is that clear? So why the value in use? Of course, you know that before, as the present value of the future cash flows to be realized from the continued use of the asset, including its disposal value at the end. So class, the higher of this, okay, is what is the recoverable value. Are we there? Okay. Are we there? So the next thing now, if you have now determined, okay, if you have now determined the recoverable value or amount, okay, of course, the carrying value is what you have in your own record as a company, and there is an impairment. So what are we going to do? Go on. Yes, go on. Hello, go on, go on, go on.
Good afternoon, sir.
Yeah, good afternoon.
Yeah, what I was trying to ask is the value in use. How do we determine that in figure? Because it is the value in use that you compare with the carrying value now to know if there is impairment. So how do we
I
determine
have okay,
value?
okay, 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 okay. I have said this more than 5 times here. It seems that you didn't get it clear. Now, the value in use, okay? The value in use is what? Is the present value of the estimated, okay, cash inflows, future cash inflows. Future cash, okay. Now, let's say this, okay, this plant has 5 years now. The management would determine, come, for each year, how much would this plant give us for year 1, for year 2, for year 3, for year 4, and for year 5. Now, that is the total cash we are going to get. Are we going to incur any expense? If you have that, you less. So what you have now, what is the discounted figure? You are going to discount it. It's called the PV, or the examiner might give you in the question directly. Is that clear? So that is that. But for those of you doing SBR, hello, it is important you understand the composition of estimate of the future cash flows. What are we saying here? What are the cash flows, hello, you are going to consider in determining the value in use? Okay, this applies to both of you, SBR and FR, yes. Okay, what are the cash flows you are going to consider in order to estimate the PV of the value in use as an organization? Please be with me here. Number 1, the projected cash inflows from continuing use of the asset. Yes, the projected cash inflows. Now, that cash inflows is the inflows you are going to realize. 2, projected cash outflows necessary to be incurred, okay, to generate the projected cash inflows. Yes, if you are going to incur any expense, okay, for you to derive that projected cash inflows, that too will be taken out. Exactly. The next now, the net cash flow received from the disposal of the asset. Yes, you know, at the end of the useful life, you are going to sell the asset. And when you sell it, cash comes in. Now, the amount you sell minus any cost of disposal you incur, okay, that is called the net cash flow received. So, from the disposal of the asset, these are the 3 cash flows, the 3 estimates you are going to consider when you are trying to determine the value in use. Like I said, for those doing FR and the SBR, okay, but sometimes the question might give you the value in use directly, and you might not need to go through all this. Now, the third now issue is the accounting treatment. Okay, treatment of impairment. Yes, the first thing that you have been able to identify a potentially impaired asset. 2, you have done the measurement. Oh, you have determined the value of impairment. Next now, how do you treat, how do you record this impairment in your account? Is that clear? Now, class, remember again that impairment occurs when the carrying value of an asset exceed its recoverable amount or value. And the recoverable value, according to IAS 36, is the higher of the fair value less cost to sell and the value in use. So if the carrying value exceeds the recoverable amount, then there is an impairment. So how are we going to account now for the impairment? Now, the accounting for impairment class depends. Please be with me here. Give me a rapt attention. The accounting for your impairment depends, okay, on the method adopted by the entity to recognize its PPE. Yes, remember, under IAS 16, property, plant, and equipment, the PPE can be measured, okay, or can be carried, okay, can be carried in the record are 2 models. 1, cost model. 2, revaluation model. So the method of carrying your PPE would determine how you are going to treat the impairment. One thing is for you to know how to calculate the impairment. Second thing is to know how to account and pass double entries for the impairment. So now, let's say a cost model. Okay. Now, when the PPE is maintained at the cost model, okay. Now, the impairment, okay, is written off to the profit or loss account straight to where? To the P or L straight as an expense in that year. you read the question, you can see that, oh, this entity carries this asset using cost model, of course, and there is an impairment. That impairment goes straight to the P or L of that year as an expense. And the value of the same asset is also reduced by the amount of the impairment. So this is the accounting entries. Debit the profit or loss, okay? This could be admin expense. You may either add to the admin expense or to the cost of sales. Yeah. Now credit now, the non-current asset. Okay. So that is what the accounting and okay trace. Exactly. So now, revaluation model. Yeah. Class, recall IAS 16 says that a PPE, okay, can be carried in two ways. Again, the cost model, okay, and what revaluation model. Under the revaluation model, okay, the asset is revalued to fair value at the end of each year. So the revalued amount you get, which is the fair value, that is going to be the closing carrying value of that asset in the statement of financial position. Now, when you do revaluation, okay, it is possible you have revaluation surplus or deficit. Please bear with me here. So, under revaluation model, the asset could be having existing revaluation surplus or deficit. Yes. Therefore, if there is an impairment, the impairment is not taken to the profit or loss directly. No, it is going to be used to reduce the existing revaluation surplus of that asset to the extent it can cover. However, if the impairment is more than the revaluation surplus, so the excess of the impairment would then be taken to P or L. Is that clear? So what now is the accounting trace? After this now, we go to calculate. Accounting trace. Okay, remember, in this case, you do not take the impairment straight away to P or L. So you are going to first use the impairment to reduce the existing reserves. So you debit revaluation surplus. Now, if the value of the impairment is more than the surplus, you take the rest now to profit or loss. Okay, account. You either add to the admin or this, anyone. Then you now want credit now, the non-current asset itself. Now, the non-current So that is that. Remember, class, that we are considering the impairment of two assets here, okay? A single asset and a cash generating unit. But today, let us consider a single asset. So right away, look at question 1. We are going to solve today like 4 questions. Yes. So after this now, I will help you post the past questions on your platform that you are going to lay your hands on. Class, please, question 1. Let's check for me. X, Y, Z. Please, everybody be there. Okay. Please, everybody. Please be there. Question 1. Please, let's go through it, class. Question 1. Sit down, class, sit down. Calculate what? The recoverable amount, okay, of the plant. B, calculate the impairment loss. Now, an item of plant is included in a financial statement at a carrying value of what? Of 350,000. Exactly. The present value, okay, of the future cash flow from continuing use of the plant is 300,000. Alternatively, look at it now. The plant could be sold for a net profit of 295,000. So, A, what is the recoverable value? Yes, let one person tell us there.
The recoverable value is 300,000.
Why, sir? Why, sir?
Because the higher of
Thank
it,
you. Thank
the
you.
higher of
Thank you. The higher. So, IAS 36, the recoverable value is higher of the fair value less cost to sell. Please, your own in full, please. And value in use. Therefore, the fair value less cost to sell The value in use. Here is recoverable value is the 300. Yes. Yes. Now B. B. Calculate the impairment class. Okay? Impairment loss, if any. Okay? Now, class, you will have impairment, okay, if the carrying value is what is more than the recovery value. So let's see now. The carrying value of the plant is how much here? Is 350. Then less now the recoverable value, which is what? 300. You have 50,000 as impairment. So the value of the plant now has been reduced by 50,000 as impairment. That is that. Actually, that question did not say we should show the accounting entries, but let me just show you. Okay, sharp, sharp. Accounting entries. You have debit the profit or loss. How much? 50,000. Also credit the non-current asset. The plant. It was 50,000. So this year, you are what? You are going to charge this, okay, as an expense to the pure help. Also, you are what? Going to reduce the value of this thing by what? 50. So it means that the value of the plant now that you will carry now is 300,000. Is that clear? Yes, go on.
So, sir, I think the value in use should have been 300, why the fair value 295 based on the question. I don't know. I want to check that again.
Are you sure? Let's check. No, 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 no. The value in use, Abi?
Yeah.
Okay, okay.
It's correct.
Oh,
That's what is in the question.
The value in use, Abi? Okay, 300. Okay, okay.
It doesn't change anything. The recovery value is still 300.
Yes, yes, but the figures is not tally. Okay, thank you. Now, that is just an intro, the eyes opening, okay, on how to treat. So let's go now first. Question number 5 now. Please, 5. Sharp, sharp. Question 5. Please, let me give you just 2 minutes, please. I want you to be involved so that at the end of this class, you'll be able to lay your hands on past questions. Yes, that is how to do it. Question 5. Thompson, okay. Please. Question 5, Thompson. Everybody, Everybody, open your material. Okay. Please open to that place, this class. 5 Thompson. Are we all there? Now, you can see here, class, the lifespan is what? Is 10, you, okay? Is 10 years, not 100, you, okay? Please, error. The estimated useful life of 10 years, not 100 years, when it's not land. With a residual value of new, okay, at December 31st, 2006, okay, the estimated selling price of the asset is only 590 million. That is the fair value. Okay, what you are going to receive from the sales of the asset with associated selling expenses of 85 million, the selling cost. Okay, now the anticipated, you that asked this question earlier, that how do we determine the value you use? Here comes now. Please be with me here. The anticipated net cash inflow from the asset are now 115 million per annum for the next 6 years. The market discount rate is 8% per annum. Now, find the carrying amount. Okay, the carrying amount. Question A. At of assets when on 31st December, this is so, this is the cost, cost of assets. Now, when was this thing, okay, bought? Check now. When did you actually say 1st January 2003? Better. It costs you here, let's say million here. Or should we use 1,000 here? Let's use 30 to make it better. 900 million. Now, when you bought this thing this year, it costs this, and you are asked to find the carrying value as at this date now. So 2003, 2004, 2005, 2006. It has used 4 years. So you say your accumulated depreciation what is your depreciation per annum? It should have been the cost minus residual value over the useful life. But in this case, okay, it has 0 new value. Let's say your depreciation should have been the cost, the 900 million less what? The value is 0 value over 10 years, right? So how much do you charge now per annum? 90 million. So you charge 90 million per annum times 4 years. I mean, 4 years. That will be 360. So for the 4 years now, you have charged your 360,000, okay, as a total deduction. So this less that. There you have 540. The carrying value. That is that. B. Question B. B says the fair value less cost to sales. Okay. The fair value less cost to sales. Is it estimated selling price, the fair value? So if you want to sell now, is how much? 590 million. 590. Then less what the selling cost. Less stated selling expenses. That is 85 million. There you have the fair value less cost to sell, or the net realizable value. That will be 505. Class, that is that. We are going. This is also showing us, okay, how to determine all those basic components in case it is not given. The C part says the value in use. Okay, the value in use. Okay, the value in use. The value in use, okay, as 31st 12. That asset has 10 years life. Okay, but as at this date now, we are doing the account. We have used 4 years. So it has what? 6 years remaining. So the value in use, okay, shall be based on the remaining useful life, 6 years. Okay. Class, you can find this value in use in 2 ways. Hello. For those of you who are students of finance, of SFM or FM, you've been taught how to do discount as a factor. Aha. You can do it that way. Year 1, year 2, year 3, and like that. But I want to teach you the fastest way if you have the same cash inflow. And if we check here very well, the question says that the anticipated net cash inflow from the asset, the inflow, the income is 150 million per annum for the next 6 years. So this is a constant cash flow annuity. Is that clear? So stop using that table to say year 1, year 2. No, that is a baby thing. How would it? So therefore, the value in use will be the annual, okay, cash flow, cash inflow times what? The annuity, okay? Yes. The same thing you have learned before. So your annual cash inflow, your annual is what? Is 150 million. Please, I will do it in full. Why? My discount factor there is what? Class, okay, it's 8%. The N is 6. So the N is what? The number of years. Okay. Therefore, my value in use is my 1 million bracket 1 minus 1 plus 0.08 abi over 0.08 over 6. Here I have 1 1. So please help me do okay, class please. What is that? Yes. Let someone please help us do the annuity and tell us. Here you have 1 minus 1.08 abi over 0.08. If you do all that, so times what you have abi, here you have 531 631 1. That is the value in use. Okay. But if you like, come and do your table. Year 1, the cash flows, discount factor 8%, the PV. Year 1, year 2, the same thing. But at this stage, please, let's use the quick one. Yes. Even the examiner too would also love this. Okay. Now, question 4. What is the recoverable value? What is your recoverable value? IAS says that the recoverable value is the higher of the fair value, less cost to sell, okay, and value in use out there. So IAS 36, this is the higher of the fair value, less cost to sales, okay, and value in use. Therefore, the fair value less cost to sell here is 5 million. The value in use too is 531 631 161. So therefore, recoverable value class is what?
531,631,161.
Okay, the value in use abi. So recoverable value is the value in use. 531 631 161. So that is what you are going to use for the impairment calculation. So the last part now, the E says calculate any impairment loss, okay, and indicate the required accounting treatment. Class E, impairment. As at 31st, Abi, 20, the carrying value is how much? Is 540 million. Yes, 540 million. Yes. Then let's recoverable value, which is the value in use, 531 631 161. Obviously, there is an impairment. Of how much? Of 8368, Abi. 8368 839. That is the accounting treatment. Still part E, Abi. Continuation of part E. The accounting treatment now you debit the P or L. Why? The asset is what is maintained at cost model, as you can see. So this impairment goes to P or L. What is here? 8386 839. You also credit now the non-current asset. What is the name? Okay. Anyway, you don't have the name, but just act as what? As non-current asset. Eight 68 839. That is that. Next, we look at the next question. Question 6, England. England. Question 6, England. Okay. Question 6, England. Are we all there? Class, please, are we all there or we are still writing?
We are writing, sir.
I beg you. Right.
Yeah.
When you have the video. Okay, please, let's go to it now, class, please. Okay, thank you. Don't worry, okay, you will have the video latest 2 hours after the class. So that we can cover as much as possible. So that by next week I end this. And that same next week we go to the next topic, next standard. Maybe IAS 20, government grants and disclosure. Okay, class, now. Lesson now. 6, England. England. Question 6, England. England. Please, I want you to go through the question and be painstaking, be meticulous. And tell me the model that is used for the asset. Yes, because that is very, very important. One thing is what?
Revaluation model.
So that tells you how you are going to do your accounting treatment. Okay. Now, question A. Question A. Calculate the fair value less cost to sale of the property at 30th September 2005. Okay, the fair value less cost to sell at 30th September 2005. I think that should be 9, the 9th month. Okay. What do you have there as a fair value? Let's check. The estimated selling price the fair value is 990 million. Is that correct? Sorry, it's 900 million, right? 900 million. So let's now associated selling expenses. That is how much?
120.
120 million. 120. So the fair value less cost to sale slash net realizable value. Class, that's how much?
$780 million.
780. Thank you. 780. That is that. Okay. The part B now says the value in use again. In use at 30th September 2005. How many years do you have left on this asset? Tell me. Thank you. 3 years. Fantastic. Now, were you given the actual cash inflow that you are going to generate from the continued use of the asset?
There, they don't run it.
Yes.
300 million.
Yes, 300 million.
300 million. Better. So, hello. So, now, since it is now a constant cash flow, Abi, annuity. So, hello, mute your mic, please. You are online. Okay, so the value in use, okay.
Hold this thing for me.
Alfred.
The value in use, okay, is the annual, okay, cash inflow you have there times what the annuity. So I have my annual cash inflow as 300 million. Then there I have the discount rate is what? 10%, Abi. 1 plus 0.1, right? Over 0.1. 3. Here I have 300 million times 1.1. From this now, you should be able to find your way. And if you like, do it that same way, okay? Year 1, year 2, year 3. You are still on the same point. 746 is 0, 55, 597. I use this because we are having the same cash inflows for the next 3 years. So to save time. The C part class, what is the recoverable value? Okay. The C part recoverable value at 30th 09/2005. Remember, IAS 36 tells me that the recoverable value is the higher of the fair value less cost to sales and the value in use. Therefore, my fair value less cost to sales Here I have 780 million, and my value in use is 746,055,5. Class, which of these two is my recoverable value?
Fair value, let's go.
780.
Thank you. The recoverable value is the fair value less cost to sell. The 780 million. The 780 million. Yeah, that is your recoverable value, class. Of course, after that is what? Is, am I there? Okay, the impairment. Okay, impairment. Okay, at 30th September 2005. Of course, that is what the carrying value. The carrying value at this date, 30th September 2005. Let's check, please. Do we have it there, or are we going to do it ourselves? Class, what is the carrying value of this property? Tell me.
950 million.
Thank you. That is the new carrying value, being the amount we value, 950 million. So less now our recoverable value is the 780.
So we're not seeing the down of the board though.
Okay, sorry. Yeah. It's 780. So what do we have there as an impairment loss?
170.
170.
So please, sorry to draw us back. Where do we get the 950 million from?
It's in the question.
Okay.
Okay. Check from the start. Okay. From the start of the question. Because this asset is maintained using revaluation model. So at the end of each year, it's revalued. So the revalued amount is going to be the new carrying value. I hope we are all there now, class. So now the accounting treatment now for this impairment. For this impairment. What am I going to do, class, to this impairment? Tell me, if you are actually following me.
You will remove
Part
the 50
of it is going to the
60 million
revaluation
estate first. So before we now put the remaining balance into the P&L.
No, say, don't do this is a partial. I want to get you clear so that I will hold you, okay, by your neck. Now, start again and tell me what I will do. Yeah.
The question, there is a surplus of 60 million.
Okay.
Yeah.
Okay.
Oh, so and 25 million of it, yes. 25 million of it is for the property. So
thank you.
We have to remove the 25 million from the 170 to the balance. We send it to the P&L.
Okay, thank you. You are correct. Okay. So this same property has been revalued before. Fortunately, it was upward revaluation that brought about surplus. So, and the total surplus in the book, okay, is 60 million, right? And 25 million of this surplus, right, relates to this particular asset. Yes, relates to this particular asset. Okay, 25 million of it. So it means what? The whole 60 million surplus is not for this alone. I am trying to fish out my own from the material. Okay, the revaluation surplus reserves of the company, sit down, of the company as a whole. You know, this company does not have just one asset. So I'm going to 60 million, of which 25 million was attributable to the revaluation of this property. So instead of taking this 170, okay, to the P&L straight, we are going to use it to reduce the existing surplus. I'm coming. So take away the whole 25 million. Now, that is the portion that the surplus can cover. Okay, Danjuma, go on.
Hello, sir. I don't know how you arrive at this 950 carrying value as of 30th November 2025, sir. I checked the solving, I can't find it.
It's in the question. Hey, that is why I say we should read the question together. Check the beginning.
England Limited now. Maybe you're reading the wrong question. England Limited, you see there.
Okay. Now, now we are having this as loss, but we can only claim this from the 117 less this. The rest will go to here to the P or L, to the profit or loss. Class, that what now? That be 145, So you now would credit now the non-current asset for the total impairment. So now, the accounting treatment for this is not the same with that of the first one we solved. Exactly. So let's take one more. Let me allow you, right? Okay, go on.
Okay, sir.
Yes,
Sir, Okay. I've seen what I wanted to ask. I've seen it. Thank you, sir.
Okay. Thank God. Okay. There is one I can pass, okay, question, okay, for the SBR. Let us do it together, please. Look at question number 9. Please, everybody go through that question. Question 9. It's an SBR question. Question 9. Question number 9. Yes. Please, everybody go through it now so that we can be on the same page. This is how we learn IFRS. Mm-hmm. 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 2 minutes more for the question. Question 9. Question number 9 from the material. Question 9 from the material. Two minutes more. Okay. We can start now, right? Mm-hmm. After this class, so I don't expect anybody to have issue with the impairment of a single asset. Yes. The accounting treatment and everything. Next week, we come to CGU only and solve questions on that. And also launch ourselves into the new standard. That's the next week. Question 9. This is an I can pass question for the SBR. Okay, but let us take it for both SBR and FR. Yeah, your standards are the same, except for those standards that are peculiar to SBR only. Yes, but you have common standard, okay, that are common to both SBR and FR. So class now, you know you have read the stories, right? So I think these companies, this company management, okay, is considering on how to go about the impairment, whether there is an impairment or not. Now, determine if the machine is impaired. Hey, yeah.
So the company is Attingen Manufacturing Limited.
Okay, yes, I know, Jerry. Thank you. Is what? Attingen. Okay, class. So please help us off your video, Mr. Anthony. Now, to do your impairment, okay, you need two things. Though that two things can be broken into three. Let's say I need my carrying value of the asset with the what recoverable value. That is why I said two things. However, it can become three. How? The recoverable value now is going to be the higher of the fair value, less cost of sales, and value in use. You can see. So, and I don't think we have any of this here. So, let us now first determine the carrying value. Class, what is carrying value? The cost, okay? The cost is it machine or what?
This is machine.
The cost of the machine. When was it what? Okay, on the 1st of January, because the date is important, please. 2015. On the 1st of January 2015. Okay.
So, but there's
Now,
something like the carrying value in the question there.
Are you sure? Okay.
We have the carrying value in the question.
Yes. Okay.
Carrying amount 80 million. 80 million.
Okay. You guys now like this thing shortcut. Anyways, let's go. 140 million, right? 140 million. Of course, is there, but let me just show you. Now, how many years now has this machine been used?
2 years.
No, check.
3 years. 15,
3 years.
16,
Okay.
17 December.
Thank you. 3 years. Thank you. So now, let's do what the total depreciation. Okay. We have the 140 million. It has what? 7 years, Abby, life. So times what? The 3 years. That'll be what? That'll be 60. That gives what? 80. The carrying value out there. So that is how we got the 80 you saw in the question. Exactly. Supposing that is not given, what are you going to do? That is my take. Now, we also need to know the recoverable value. And that is what the higher of the fair value, less cost of sales, and the value in use. So we can also find the fair value, the less cost of sales. So the estimated selling price is how much? Is 60 million, Abi? And the cost to be incurred
62 million, no, not 60.
62 million.
Okay. Wow. I'm having 60 here. So let me work then, okay, with what you have there. Yes, it is a concept you need. Now, what is our cost to sales there? Tell me.
5% of the fair value.
Thank you. The 5% of the 62 million.
110.
To what?
110.
To
3.
110.
3, sir.
Okay. So this is what we are going to realize after the sales and take away the expense. So that's what now? 62 million minus 3,110, 58,890. 58. Also, we need to also find the
5%
value
of
in
52 million is 3,100 though. So I have
3
to
million.
calculate that thing again.
The
which
cost to sell 3,100,000, not 310.
I cut this short from. I thought you understand.
okay. Thank you. 62 minus 31. 58,900. Hello. 58,900. Please mute your mic, please. Okay, that is that. Now, how do we find the value in use? Do we have it there?
Yes, sir. We have it.
Yes, we have it.
63.5.
Thank you. So the value in use given 63.5 million. Therefore, now we can now find the what? The recoverable value. The recoverable value now. The recoverable value is the higher of the fair value less cost to sales and the value in use. Therefore, the fair value less cost to sale that we got here is 58.9, and the value in use as given is 63,500. Therefore, the recoverable value is a value in use of 63,500. So we can now find out the impairment. So impairment now, the fifth. Okay. The carrying value is 80 million less recoverable value. That was 63.5. That is the higher class. The impairment now is how much? Tell me. 16, Abi. That is the answers to that. To the part A, you can say. So, this is the
Sir, please look down
impairment
on the
charge.
board.
This is the impairment charge, okay? The directors should take to the P or L. So, what is the impairment that we should recognize in the P or L? Let me come here. The impairment charge, okay, is 16.5. So the accounting treatment debit the profit or loss, Abi. It could be admin or your cost of what? Of sales. For those of you who have done this before, group account, you say 16.5. Excuse me. Let me help you so that it can contain that place. Debit your profit or loss. The admin or the cost of sales. Debit 16. Now, credit now. The non-current asset. The what? The machine. $16. So class, that is a full 20 marks question. Full one for SBR. Full 20 marks. Okay. You can see the diet of the question in that material. Is there. So, and we have posted all the materials, the past questions across all the platforms. So there should be no one here that does not have the material. Please, class, any question? Yes.
Yes, sir. Sir, in a situation where hello, sir.
Yes, ma'am.
Okay, sir. I said in a situation where we have the recoverable value is higher than the carry value.
Thank you. That is good. Okay. Now, some people, okay, would have said that should be an impairment gain. No. In that case, then, okay, the standard is very, very clear. Says that when the recoverable value is now more than the carry value, then there is no impairment. So the asset should still be maintained at the carrying value. Madam, are you clear?
Yes, sir. Thank you, sir.
Madam, okay. So that is that.
Sorry, sir. Good
Class
afternoon, sir.
again.
Please, sir. Hello, sir.
Yes, sir.
Please, sir, can you help us repost the Pathfinder for some of us that just joined, I think, this week?
Okay. Okay.
That's for all the platform. Some of us are in other platform also.
Okay.
Thank you, sir.
So class, thank you. Okay, very much. Please, let's start solving now. Please. As there is no more time.